Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Dean Curnutt, founder and CEO of Macro Risk Advisors. We're going to take a look at the market's Fab Five, those factors driving risk in the market right now. Dean, it's great to have you with us. Welcome to Trade Talks. And I feel like as traders and investors, we're always looking for a point in time that we can either correlate or discern differences in market activity. When we look at the Nasdaq 100 now versus what we experienced in March 2020 with the pandemic sell-off, where are the differences? How do they relate to what's happening with inflation and Fed policy?
Yeah, thanks for having me on. There's a couple of similarities, but some very, very important and distinct differences as well. The similarities really start and end with the size of the drawdown. So amazingly, we have a 26% drawdown right now in the NDX. And that's very close to the 28% drawdown we experienced during the pandemic. You'd think that the pandemic would be a lot worse. It just was so sharp and volatile. And of course was stopped because of so much Fed policy and fiscal policy that kind of rode to the rescue. So similarity in size, but difference in the degree of volatility. Over the course of the drawdown in 2020, the realized volatility in the NDX or the QQQ was 85%. It's only 32% now. So again, just much sharper. And the other difference that we can dive into is just the degree to which the Fed was your friend back in 2020 and is really turned unfriendly to the market as it tries to satisfy the inflation part of its dual mandate.
Let's talk about the Fab Five here. Tell us what those are and how they've defined the risks since 2021.
Well, I was just looking for some analogies last year in 2021, and I think I came across a ESPN special on the original Fab Five, the Michigan Freshman Five that did so well as freshmen in the NCAA, making it to the finals in 1991. And so 30 years later, I thought, well, the market's got a Fab Five too, a sarcastic Fab Five that is. And in the case of specifically the QQQ, the Fab Five was valuation, concentration, correlation, duration, and inflation. So let me just run through those all. So first and foremost, tech stocks got massively overvalued. Very difficult to compete with the original tech bubble, but there was just so much froth that's still in the process of being worked off. So that's the valuation part. Concentration is that the top 7 stocks in the QQQ constituted almost half of the market cap of the index. That is a tremendous amount in the top end of the index, and that just gets you much less diversification when you have 7 stocks account for 50% or nearly 50% of the market cap. And then there's this idea of correlation. We have been or had been in this regime of negative correlation between stock prices and treasury prices, treasury bond prices. So that's risk on, risk off. When the stock market falters, the bond market's there to pick up some of the slack. It rallies on days the stock market falls. And that's really what's changed. The correlation between stock and bond prices has actually turned positive. Over the last month, for example, if I just look at the correlation between the S&P and the TLT, it's positive 33%. That changes your risk profile a ton. It adds to your risk profile. And then really quickly, duration is just this idea that tech stocks specifically had become more exposed to higher interest rates than at any time over the past, I would say, 2 decades. And then lastly, just to kind of bring the Fab Five together, is inflation. We all know that that's been a driving factor in markets, and it's just imposed specific vulnerability on the QQQ and tech stocks.
You know, Dean, so interesting as we discussed this on Tuesday, May 10th, for those of you catching the replay, I'm sitting here scratching my head. We have spot VIX just under 35, right? And we know we're in corrective territory. We're thinking about bear markets at this point. So explain to me, let's talk about the ratio of the MOVE index to the VIX index and how it's useful to understanding equity market volatility, because it seems as if it's a little bit disconnected. When the pandemic moves, we were over 80 in the VIX. So how do we figure that out?
Yeah. So again, the pandemic was so unique in the sense that the drawdown was so sharp. When you close an economy, you're going to see massive moves. There were 3 consecutive days during that drawdown period in March of 2020 when the S&P experienced moves of 9% or more. So it leads to a massive amount of realized volatility, and that's what's going to get the VIX to a new all-time high, which we saw in March of 2020. This period is very ugly, but it's a little different. You definitely have a lot of volatility. The 10-day realized volatility in the S&P is about 40%. That's sky high. Certainly not pandemic high, but it's very high. One of the things we noticed at Macro Risk Advisors is this discrepancy between very high interest rate vol. So a commonly used metric there is the MOVE index. That's kind of your VIX for the bond market. That had gotten into the 120s, even as the VIX itself, and this was about 3 weeks ago or so, was down around 20. So we just drew a time series dividing the MOVE by the VIX. There's nothing, there's no free money to be had in that relationship, but we thought there was some good information content. And so at some point it was 120 MOVE and 20 VIX. So the ratio got to 6. And we just found that to be very high, with the idea that the bond market had to settle down for stocks to start to be able to see the path forward. And a 120 MOVE index is not a settled bond market. So it struck us that either the MOVE index had to come down or the VIX had to go up. And the MOVE index is still in the 120s, but of course now the VIX, as you mentioned, is at 34.
So Dean, bonds are selling off, equities are selling off. We don't have the Fed support in the market, so we have to try and find insurance somewhere. Tell us about using options to protect portfolios.
Yeah, so that's your only bona fide insurance is to pay premium. I like to use an analogy that if you bought a house and you called your neighborhood flood insurance broker and you said, how much is flood insurance for a year? And they told you it was free, you'd probably say, well, it's too good to be true. And unfortunately in markets, sometimes there is this sense that insurance can be had for free. That's kind of what the bond market provided for a long period of time. It was an offset to risk in the equity market, even as it carried positively. It delivered a positive return. But that's not true insurance, as we're seeing that come undone this year. True insurance is going out into the marketplace and buying put options. And put options are expensive. This year, the VIX has averaged 25. And a little back test of just buying weekly puts on the S&P 500 that are struck a little bit below the spot price, believe it or not, is only broken even. So you'd think, wow, the S&P is down 18-ish% for the year. I assume buying puts would be fabulously profitable. Not the case. And that really comes down to the fact that the actual insurance is expensive with a VIX of 25. So there's nothing easy about this market in terms of risk mitigation.
And finally, Dean, tell us about Macro Minds.
I started Macro Minds. It's a charitable foundation. I started it a couple of years ago with the intention of supporting local charities that are focused on student education. We all know how hard the pandemic has been for all of us, but certainly students have fallen behind in a lot of ways. And it's the students from families with less resources in communities with less resources that have found it especially difficult. The idea behind Macro Minds is to bring the investment community together for a once a year conference, a symposium where we dive into things like the VIX, things like monetary policy and inflation, digital assets, risk in the markets, portfolio construction. And each year, what we do is we pick 3 charities to support and just try to sell as many sponsorships and tickets to our event. It's coming up next week. It's May 18th and 19th in New York City. We've got a tremendous group of voices that have decided to donate their time and reputations to the causes that we're representing. The first day, the keynote speaker is Mike Novogratz, the founder of Galaxy Digital. And the second day, we're really honored to have Paul Singer, the founder of and co-CIO of Elliott Management, do a talk. So we've got a great 2-day agenda. We've got 40 plus sponsors that we're still growing, and just excited to be able to have an opportunity to bring our community of finance professionals together to raise money and to learn at a critical point in the risk profile of markets.
Yeah, that's a pretty amazing cause, Dean. Thanks for sharing that with us. And thank you for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.